Welcome to Value Vest Daily. Today, we're diving into a stock that has been on an absolute roller coaster, Eos Energy, ticker EOSE. Now, this is a company right at the heart of the green energy transition. But wow, its latest earnings report sent the stock into a free fall. So we're going to dissect exactly what happened, unpack their unique technology, go deep into the numbers, both the amazing ones and, frankly, the terrifying ones, and try to answer the big question. Is this massive 40% crash a sign to run for the hills? Or is it one of those rare, high-stakes buying opportunities? Let's get into it. So just imagine this. On February 26th, investors in Eos Energy woke up to a complete bloodbath. In just one day, the stock collapsed by nearly 40%. I mean, this wasn't a slow bleed. It was like falling off a cliff. And a move like this really forces you to ask some tough questions, right? What on earth just happened? Did the entire story behind this company just get blown up overnight? Or did the market just totally overreact, maybe creating a massive discount for us? And that really brings us to the heart of our explainer today. You see, a 40% crash can be one of two things. It can be a massive red flag, a clear signal that the ship is sinking and it's time to abandon it. Or it could be the market irrationally punishing a company for some short-term pain while completely ignoring a huge long-term opportunity. Our job is to figure out which one this is. And to do that, we have to put on our investigator hats and figure out what caused this panic in the first place. Okay, so let's start right at the source of all the chaos, the Q4 2023 earnings report. The numbers in this report are just a perfect example of a company being pulled in two completely opposite directions at the same time. I mean, on one hand, you have this explosive, almost unbelievable growth. But on the other hand, you have these eye-watering financial losses. Let's break down the exact numbers that sent the market into a tailspin. So check this out. The top line number, the revenue, is just spectacular, a 700% increase year over year. I mean, in any normal situation, that kind of number would send a stock to the moon. But then you look at the bottom line, a net loss of nearly $1 billion. Now, yeah, that includes some non-cash items, but it's still a staggering figure. So the market saw this incredible growth but got completely spooked by how much it costs to get there. The big question became, can this company even survive long enough for that growth to matter? That's the conflict that just hammered the stock. Okay, so to figure out if Eos can survive, we first need to get what they actually do. I mean, why is this company generating so much buzz in the first place? Eos isn't just making another battery. They're trying to solve one of the single biggest problems in the entire renewable energy revolution, and they're doing it with a unique, American-made technology. This is the big idea, the real bull case for the company. Eos plays in a really critical field called long-duration energy storage, or LDEs. And here's why that matters so much. You know, solar panels make power when the sun's out, and wind turbines work when it's windy. But what happens at night or on a calm day? The grid needs power 24/7. LDEs is the answer. It's all about building these massive batteries that can soak up all that green energy for hours. We're talking 3, 12, or even more, and then feed it back into the grid when we need it. Honestly, without LDEs, a fully renewable grid is basically a fantasy. This is a foundational piece of our energy future. And here's where Eos is doing things differently. Right now, the king of batteries is lithium-ion. But think of lithium-ion like a sprinter. It's fantastic at giving you a powerful burst of energy for a short time, you know, like in your phone or an electric car. But for grid storage, you don't need a sprinter. You need a marathon runner. And that's exactly what Eos's zinc-based technology is designed to be. It's built for those longer durations, it's non-flammable, which is a huge safety advantage, and critically, it uses abundant zinc that can be sourced right here in the US, which means they get to avoid all the messy and complicated supply chains for things like lithium and cobalt. This focus on American-made, zinc-based tech gives them a really powerful competitive edge. It puts them in a perfect spot to get benefits from things like the Inflation Reduction Act, and it gives them a patent-protected moat around their designs. Plus, they're not sitting still, they're innovating. They've got this new Indensity architecture designed to pack more energy into a smaller space, which is key for cities where land is expensive and fire safety is everything. This is not a copycat product. It's a totally different and strategic approach. So, we've got a potentially game-changing technology in a massive, growing market. But is anybody actually buying it? This is where the bull case gets really, really exciting. Let's shift gears and dive into the data. We're going to look at 3 numbers that tell a powerful story about Eos's momentum, from what they've already done to the giant opportunity that's still ahead. All right, The first number is that incredible 7x revenue growth we mentioned. Hitting over $100 million in revenue for the year is a huge milestone. Now, yeah, it came with those big losses, but it proves one absolutely critical thing. They can sell their product. They have officially moved from just being a cool idea to a real business with real customers and sales that are growing like crazy. This is the first and maybe the most important proof point you need to see. Now, this is where it gets even more interesting. This isn't revenue they hope to get someday. This is their current order backlog. The $701.5 million represents signed contracts and committed orders that they are working to build and deliver right now. Think of it as secured future revenue that's already in the bag. This number proves their tech is valued in the marketplace, and it gives us a clear line of sight into their business for the next couple of years. It shows that 7x growth wasn't a fluke, it's just the start. And this number, well, this is the grand prize, the $23.6 billion commercial pipeline. Now, to be clear, this isn't a backlog of firm orders yet. This represents potential deals, projects they're negotiating, and qualified leads that the company is actively going after. It's a measure of the total demand that Eos is realistically targeting. Are they going to win all of it? Of course not. But it shows you the unbelievable scale of this market and Eos's position in it. This is where that long-term, multi-bagger potential that gets investors so excited comes from. And to top it all off, management is putting their money where their mouth is. They've guided for somewhere between $300 and $400 million in revenue for 2026. If they hit that, it would be another 2.5 to 3.5 times growth on top of the 7x growth they just delivered. This shows you just how confident management is in their ability to turn that massive backlog into actual real revenue and keep this explosive trajectory going. Okay, the growth story is incredibly compelling. You've got this revolutionary tech, a massive market, explosive sales. It's easy to get carried away. But now we have to do what responsible investors do. We have to take a deep breath, push all that hype aside for a second, and do a serious reality check on the company's financials. Because right now, this company is a cash-burning machine. This slide right here, this lays out the heart of the bear case. Let's just walk through it. Earnings per share, or EPS, is deeply negative. That means the company is losing a lot of money for every single share out there. EBITDA, a measure of core profitability, confirms they are just burning cash to keep the lights on. Now look at gross margin. It's negative. That's a major red flag. It means right now it costs them more in materials and labor to make and deliver their batteries than they're actually selling them for. The debt-to-equity ratio is high, which tells us they're using a lot of borrowed money to fund their growth. That adds a ton of risk if things go sideways. And maybe the most telling thing of all, institutional ownership is only about 3%. That means the big Wall Street friends, the smart money, they're staying on the sidelines for now. They're likely waiting for a clear path to profitability before they jump in. And this brings us to the single most important question for anyone even thinking about investing in EOS. The growth is real, the technology is compelling, but none of that matters if they run out of money before they can actually turn a profit. The entire investment thesis hangs on this one question. Can they execute, scale up production, fix those negative gross margins, and simply survive this incredibly expensive growth phase? So, we've looked at the fundamentals, the business story, the incredible growth, and the pretty ugly financials. Now let's look at what the market itself is telling us right now through the stock chart. How does EOS actually look from a technical perspective after that 40% crash? From a technical standpoint, the chart is definitely weak. The stock is trying to find a floor, a support level, somewhere in that $6 to $7 range. The old support around $10 to $12, well, that's now likely become a resistance ceiling that it's going to have to fight through to recover. It's trading way below its key moving averages, which just confirms the current downtrend. And on top of that, its beta of 2.15 tells you the stock is more than twice as volatile as the overall market. So yeah, this is not a stock for the faint of heart. But there is one little glimmer of hope here, at least for short-term traders. The Relative Strength Index, or RSI, is down in the 22 to 35 range. Now, generally, a reading below 30 is considered oversold. But, and this is a big but, that does not guarantee a reversal. A stock can stay oversold for a long, long time. What it does suggest, though, is that the selling pressure has been extreme, and the stock could be due for a bounce, or at least a pause in its decline. It's a key thing to watch for any signs of stabilization. Okay, before we pull all this together and give you our final take, it is absolutely essential that I state this clearly. This is not financial or tax advice. We are analyzing publicly available information to educate and inform. Every single investor's situation is unique, and you must do your own research and talk to a professional before making any investment decisions. All right, the moment of truth. We've looked at the catastrophic drop, the revolutionary tech, the explosive growth, the terrifying financials, and the beaten down stock chart. It's time to bring it all together. Weigh the bull case against the bear case and answer that one central question. Is Eos Energy a buy right now? Here it is, the entire conflict in a nutshell. The bull case is this incredible story of disruption and massive potential. You've got a unique American technology, proven explosive growth, a gigantic pipeline, and a stock that is technically oversold. The bear case, on the other hand, is a story of extreme risk, staggering cash burn, immense pressure to execute flawlessly, a lack of big money investors, and just wild volatility. And the crucial thing to understand is that both of these stories are true at the same time. So, is EOSE a buy now? The answer is, it depends entirely on what kind of investor you are. Based on our deep dive, EOSE is not a stock for your retirement account. It's a high-risk, high-reward speculative investment. This is purely a bet on execution. If you believe management can successfully get through this cash-burning phase, ramp up production in 2026, turn those gross margins positive, and start turning that massive pipeline into profitable revenue, then the current price could look like an incredible bargain a few years from now. It's a bet on the tech, the market, and the management team. This is for investors with a very high tolerance for risk and a long-term time horizon of at least 3 to 5 years. So, what's your take? After seeing all the numbers, do you think the risk is worth the potential multi-bagger reward? Let us know what you think down in the comments. Please subscribe, like, and share Value Vest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities.